Let's move on here to the markets in Hong Kong, where the index has retreated over 6% from this year's June 12 high. Marco Mack joins us now in the studio. He's head of research at Fook Securities. Good to have you with us, Marco. I know you've got 4 buy recommendations here. You got Sinopec, Swire, Beijing North Star, and Pacific Century Premium Development. But first, let's talk about Sinopec. Okay. It's a refiner, so when oil goes up, its costs go up as well, and that's pretty much putting a pressure in margins. So really, everybody is looking at the end demand. Do we have enough of demand in order to support those additional costs?
I think in China, the demand for oil should not be a problem. I think the major concern last year was very high price oil market. This year, I think oil prices will come down to a level that will be quite favorable for Sinopec.
How favorable?
I think in terms of the refining margin, I think if oil price stay at around $60 to $70 US per barrel, that will be quite a good level for them to turn around the refining business. I think the first half result should prove this.
Yeah, but there's this other concern here that the government really is the one that controls Sinopec's and other refiners in the way of setting costs, so they really don't have that much scope in having to raise prices.
I think the government put in increasing flexibility in determining the price for refined oil products. In fact, I think they set out a rule that if oil price fluctuates more than 4% in the past 22 days, they can allow some adjustment in the refined oil product prices. I think that will be the reform will be going forward.
So you're saying that the system is flexible enough in Sinopec's favor?
Although there could be some time left, but I think that the mechanism should allow more flexibility for oil refiners to protect their margins.
Marco, just a question going back to the situation in China. As I say, investors do seem to be thinking about tighter interest rates. If that happens, we could see asset prices come off, which would affect share prices. We could also see a cutback on spending on things like fuel. How likely is that to happen, and how much would that affect Sinopec?
I think because Sinopec is still serving the China market, so basically I think it's very dependent on domestic demand. In fact, I think you can see China is very aggressively looking for oil resources. So basically, that means demand in China should not be a problem and should not be, by and large, unaffected by other countries.
I mean, that begs the question: how fast do you think this diversification process will be out of US dollar assets, particularly treasuries, and into things like commodities?
I think that certainly will be a gradual process. I think they cannot change the portfolio too drastically because if they dump the US dollar, that will be they will be the major victim. So I think gradually they will diversify into other reserve alternatives, other currencies, and even other commodities. Basically, I think the commodities we're talking about oil, the metals. I think that will be keenly sought after by China, alongside the economic development. So I think that makes sense for them to diversify from currency to commodities.
Marco, you're seeing further upside of over 10% for Sinopec shares?
I think so. Should be.
Why would that be the case when shares have already gone up 30% this year? Isn't that already expensive?
But I think it's still lagged behind the market. If you compare the rebound in the bond market, Sinopec is still lagged. So I think people still have some concern about the outlook. And the valuation is still looking quite compelling compared with, for example, PetroChina's CNOOC.
But when you look around the region, isn't there better value elsewhere, like regional refiners like India's Reliance and Thailand's PTT? Have you considered those?
They are already the largest refiner in Asia, and also because they serve China, that is the largest consumer in the world. So I think the backdrop should be more favorable for Sinopec.
Marco, any concern about debt at Sinopec? Last reported figures we have about 74% debt to equity, kind of high.
Well, but China Enterprise, the average gearing has been quite high. So I think Sinopec, at such gearing level, is just moderate.
So you don't think there's any need for it to pay some of that down?
Not at the current level, I think. Certainly, I think they need to expand their business. Also, they're looking for upstream oil resources, and that means they will need more capital in the future. But I think, for example, if there's any asset injection from the parents, they will be issuing new shares to parents, something like that.
Marco, I wanted to bring up the comparison you made to PetroChina versus Sinopec. PetroChina, as we know, is a more diversified company. So, I mean, it makes a lot more sense to invest in a company that has other revenue streams, unlike Sinopec.
I think the major difference is that PetroChina still, has a concentration on the upstream. And for Sinopec, it's just on the other hand, they have, more concentration on the downstream business. But I think if you are, looking for a growth story in China, I think we would like the consumption demand story. So PetroChina, the upstream business will be more or less, affected by international oil prices. But I think for Sinopec, I think they will, they will have, the business will be driven by domestic demand in China.
Okay, Marco, you've convinced me, but do I buy on dips or not? I mean, do you think there's going to be some kind of correction over the summer?
Not really. I think June we saw a month-long consolidation already. So I will believe that July could be an up market after the consolidation in June.
Okay.
Okay, well, it's good to speak with you. And Paul, thank you so much for joining us.